All right, welcome to episode 19 of Bullish. Remember, anything that we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. I'm Sam Hardy. We got Nick Stenger, of course, producer Owen. We are Stenger Family Office. For the past 43 years, it has been our mission to deliver clarity and confidence to help secure your financial future. Got another great episode lined up for you. Remember, if you're a fan, like, subscribe, share the clarity, the confidence, the good news. And we've got a fantastic guest joining us today, Kevin Simpson from Capital Wealth Planning. I'll let Nick do the formal introduction, but Kevin, just wanted to say welcome to Bullish.
Thanks for having me.
All right, Kevin Simpson. And I just found out I am doing your bio here, so let me know if this is all correct. But I understand you are the founder, CEO of Capital Wealth Planning. You're based in Naples, Florida. Not a bad place to hang out, by the way. Grew up going down there on vacation. You guys are managing about $10 billion in assets with a B, 10 billion with a B. And sounds like you focus on high quality blue chip stock portfolios and generating additional cash flow. Been doing that since 2005. Is that correct?
Yeah, that's correct, Nick.
Oh, very good. And Kevin is a graduate of George Washington University, where you majored in finance. You live in Naples. You've got a son, Jack. We were just talking before the show. I've got a son, Jack. So right off the bat, we're already off to a good start.
Yeah, strong name, Nick.
Oh, yeah, absolutely. So I know we've got a picture here of something you posted, Kevin, the Dow 40,000 hat. Pretty historic. Producer Owen, throw it up there. And pretty wild stuff that we did hit 40,000 on the Dow. Kevin, talk about that. Is that kind of on target with when you expected us to hit that number, or were you surprised by that?
Well, I think in all honesty, it happened a little bit faster if you look at where we were from 35,000 to 40,000, but on a percentage basis, it keeps getting easier and easier. So looking forward to the Dow 50,000 hat if we're lucky enough to get there.
Well, and we've got the Dow 500,000 hat. Hopefully we're all live to see that happen. We'll see. Maybe 35, 40 years down the road, we'll hit it. But sounds like you guys have been bullish for quite some time now. Would you agree with that?
I think we're cautiously bullish, only because of the fact that we're looking at a very, very strong labor market, which really fuels so much of the economy. I wish I had thought of the Dow 500,000 hat, because you can get a lot of mileage out of that one. My 40,000 one's already yesterday's news. So kudos to you guys.
Oh yeah, we could order thousands of those and just keep them in the back until we hit it. So, but why do you say cautiously optimistic, cautiously bullish? Why do you put that qualifier on it?
Well, I've been doing this for over 30 years, and my job is to be cautious because we are responsible for clients' conservative equity portfolios. So I'm not a strategist that's out there looking to try to outperform with the most speculative things. I'm really trying to focus on being the protective core allocation. Although there's risk in the stock market, even in my blue chip, more conservative world, it's my job to worry, and it's my job to be cautious. If you have a portfolio manager that isn't cautious, expect to lose money.
Absolutely. Yeah, we've seen that with Kathy Wood at ARK. Not to name too many names here, but she was named the one of the largest wealth destroyers next to the triple inverse leverage Qs or whatever. So unfortunately just hit the kind of hit that market top a little bit too heavy, and then got into tech stocks when valuations are pretty elevated. So why you go back a couple years, I mean, it almost seems like today we're talking more about the 90s, the late 90s, and the tech bubble right now in 2024 than we should have been talking in 2021. How did so many people miss that when, like Peloton was trading at $56 billion market cap, like they were going to sell us all 5 Pelotons? How did so many people get that wrong in 2021?
Well, I'm not sure that people got it wrong. Clearly, the prices were escalated, but you have to remember that there was a meme craze that took place post-pandemic that really made the valuations nonsensical. And you make a good point comparing those stocks to the early 90s, because it was no different than 98, 99. There were Yahoo chat boards that would pump up these .com companies to no end. And what we saw was just a complete repeat of that. When I was taught the business, it was a simple conversation. Like when we're looking at companies, we're basing them on valuations. So you need earnings to be able to support valuations. And to your point with the meme stocks or the .com stocks during that bubble, they didn't have earnings, therefore there was no PE. So the rationale behind it is if you tread into companies that don't have earnings, beware, because the bubble bursts at some point. And I think that a lot of institutional money was bypassing those names completely, but there was a massive retail presence that I think had a lot of fun really discussing and trading companies as they did in almost the same way in 98 and 99. With social media now, it's just more commonplace to be aware of it. It was a little bit more underground, I think, in the late 90s.
Now, would you agree with the people that say today is we're in another tech bubble? You look at NVIDIA, you look at AMD, look at some of these chip manufacturers, some of the other parts of AI. Do you think we're in a tech bubble right this second?
No, I don't think we're in a tech bubble. I think that it's easy to make an argument that they're priced to perfection and perhaps they're a little bit escalated from a valuation standpoint, but people will always pay up for technology. They'll always pay up for innovation. I don't know that I would count Cathie Woods out for the long term. There's definitely opportunities that will be life-changing. And when you mentioned the companies that you did, there's justification for the massive run, because you're beating your earnings by 200%, and increasing them at that type of rate is somewhat unprecedented, but it does allow for the valuations to go up. So if you look at NVIDIA specifically, and it's not a company we own, we really stick to dividend paying companies, like think very boring blue chip. But the valuation on NVIDIA, the multiple is, many could argue, it's a lot cheaper here today than it was a year and a half ago. Now, can they continue to do 200% beats on earnings? That remains to be seen. But so far, that's the difference between a true bubble and what we saw with the meme stocks, as you mentioned earlier, versus what we're seeing with megatech now, because the enthusiasm behind AI, I think, is legitimate. We don't know who the winners will be. We don't know where it's going to shake out, but you can be very confident in the fact that when NVIDIA is making a chip and selling it for that exorbitant price, that those earnings are real. It's not some speculation based on a philosophical idea down the road.
And would you consider a lot of the Mag 7 to be blue chip today? Would you consider Apple to be a blue chip? Would you consider Amazon? Some of these names that you would think of as tech in the past that are now so ingrained in our day-to-day lives. Are you truly talking, the Procter and Gambles of the world, so on and so forth on that front?
Because we focus on dividends, we tilt more towards that traditional value, even more boring space, but we allocate to every sector in our portfolio. So I do have a technology sleeve. Our maximum tech portfolio, and the maximum for any sector, is going to be 25%. So I'm always going to be light on tech. But we've owned Microsoft for 12 years. I mean, it's done very, very well as of late. We never sold it. We've trimmed it a lot along the way, but we've never sold Microsoft. By comparison, you bring up Apple, which is a stock we've also owned off and on for the past decade plus. And during that time period, we've sold out of our Apple position in its entirety 9 times. So there's been 9 instances in which we've been out of Apple. Fortunately, we were proud to report that we got back into it recently, at end of last year, average price about 175. So we sold it in November at 187.5. Of course, the next week it's 200, right? Why wouldn't it be? Murphy's Law. Now we rotated into Broadcom, and that was a really good trade. But what happened was then Apple at that 200 peak went down to 190, and then it went to 180, and we bought it. Went to 170, we bought more. Went to 164, we bought the rest of it. So with an average cost of around 175, stocks really come to life. And again, there's a lot of AI enthusiasm behind that, but there's also a profitability component, which is real. If indeed we're all going to go out and get new iPhones, either this cycle or next cycle, so that they can be more AI efficient, that's tremendous revenue, plus the service model. So although Apple is within the tech space, it's a stock that we can own because of its strong dividend growth.
Now, Kevin, one of the qualifiers you put on your portfolio is quality, and obviously high quality. So how do you define high quality?
Quality is very subjective. So that's an excellent question. For us, we look at breaking down the portfolio primarily using S&P 100 names. So there's a quality component within the S&P 100 inherently. Now we can dip into the S&P 500 on occasion, we will, but we're looking for then companies that pay dividends. So you're filtering even further. Is dividend a qualifier? I think it is, as long as they have earnings to support a dividend. The dividend in and of itself isn't necessarily a qualifier. And then the real driving force behind the engine of our portfolio is identifying companies that have a strong history of dividend growth. And we're looking literally for a 10% dividend growth each and every year in our portfolio. That's a very high bar. But for the past 12 years, we've achieved 9 and change. So if you're getting a raise, think about a 9+% raise every year. That's truly a hedge against inflation. Whether inflation's at 9% or it gets back to the 2% level, that's really the most important component within our strategy. Now they have to have the earnings growth to support the dividend growth. And then our thesis just falls back into just good old-fashioned investing 101. If we invest in great companies that are increasing their earnings, eventually through a full market cycle, we would expect their share price to appreciate. Not always within a Gregorian calendar, as we're measured as portfolio managers, but generally speaking, the longer time that we can look at and run our portfolio and kind of look at the analysis, we see that these companies increasing earnings, also increasing dividends, tend to be really great total returners with a lower vol, less downside capture.
How do you find, and we just did a podcast, by the way, about Americans' iconic, we would call them distressed brands, not necessarily from a balance sheet standpoint, but just, hey, earnings growth is slowing, revenue growth slowing. We're talking companies like Starbucks, Nike, Disney. We were talking Walgreens last week. So what's, in your opinion, what's happened to some of those names? You've just seen a lot of those names completely fall apart. Macy's has never really been a good stock, but they look like they were going to get acquired. Now it looks like they're going to not get acquired. So how do you think about some of those names where they are dividend payers, but it's not really, there's really hasn't been a revenue growth story there?
Well, they shouldn't be dividend payers when they don't have the earnings to support it. Maybe Nike could be an outlier in that comment, and to the same degree, maybe Starbucks could be an outlier in that comment. But things change. Before you were born, there was the Nifty 50. And these companies would be perennial dividend payers, and they're no longer, in many cases, in business. And I'll think of, the iPhone and the camera is the best example. So if we go back and we look at Eastman Kodak and Polaroid and things of that nature that were revolutionary blue chip companies, that go by the wayside when technology gets better. Will Starbucks and Nike go out of business? No, I doubt it. There's a China effect there. Will Walgreens go out of business? Probably not, but there's an incredible Amazon effect there. So when we're looking at these investments, the way we pick stocks, the way we select an investment, that never changes. But the names that we own over time absolutely do, because of earnings growth or deceleration. We used to own Nike. It's not a stock that we own. We used to own Starbucks. It's not a stock that we own. I'm proud of the fact that we haven't owned them in a few years, because they've been suffering pretty badly as of late. You also mentioned Disney. That was a stock that we used to own, and we sold it during the pandemic because they suspended their dividend. The second that Disney was no longer paying a dividend, was no longer a candidate for our strategy. But I bring that up because I think the board was correct in suspending the dividend. Like, that was well managed, and thank goodness for Disney Plus, because we weren't going to sporting events or theme parks or cruises, nor were we going to the movie theaters. So that was a situation where they had to cut the dividend. They had to really rethink the concept of the entire company. And I think they're doing a good job. They had a management misstep, and they're back on track. So it's a candidate for us again. The dividend's reinstated. We don't own it at the moment, but companies can come back from problems. Will Peloton come back to the prices that it traded at? No, of course not. But Nike could, and Starbucks could. They need some changes. They need some redirection. They're not, again, stocks that we own at the moment, but they're definitely candidates for coming out of that doldrum at some point. I don't know that I'd rush in to put new money to work there and trying to bottom fish, but I would keep an eye on them.
My Peloton is currently a clothes rack in my basement, so I doubt they will be coming back to the $56 billion market cap. I think you're correct. What about
I don't think
energy?
yours is the only one.
No, I think you're right. What about energy? I mean, do you think energy is overvalued here? There's some talk that, let's say when we get into the election season, whether it's President Trump or not, looks like there's a good shot. We've got a Republican Congress pretty heavily in the House and the Senate. So that seems like it would be good for energy, but does energy supply get opened up and then do prices come down? Does that make energy overvalued right now, or what are your thoughts there?
I would consider it to be fairly valued. I mean, we've been big proponents in energy for the longer term. We don't think that the electric vehicle is going to replace the traditional ICE vehicle in the very short term. Plus, there's lots of other things that we use with petroleum products that we don't always think about. Recently, we reduced our Chevron position. You know, the numbers with Chevron have not been as impressive lately for the past few quarters. We've owned it for over a decade. We still own it, but we own a much smaller allocation to it. We have Marathon Petroleum and ConocoPhillips, which we feel have really solid dividends. They're not out there looking for CapEx or exploration. They're looking to distribute cash flow to shareholders. So we like that part of it. Overvalued, probably not by any means. Undervalued, I don't think it's in that space either, but pretty fairly valued. And we like them for the dividends, the dividend growth, and in many cases, special dividends that they pay out. So if you see pullbacks in the energy space, I would use them as buying opportunities. I would not be a seller. As far as the election's concerned, you know, we've seen energy do well under both President Trump and President Biden. So it's not like there's going to be a big surprise to what happens with energy. Typically, Republicans have been, you know, better for the stock market in theory as we're talking about things, but you never know because tariffs can play a part in what the future could hold from a profitability standpoint. Tariffs can be very effective as long as they're not too egregious, because ultimately it's a tax on the consumer if pushed too far.
Kevin, one of your top holdings is JP Morgan. How are you thinking about banks right now? Obviously, earnings came out kind of a mixed bag. Goldman had great earnings. JP Morgan almost always has good earnings, especially now since they're the only game in town in a lot of ways. Morgan had okay earnings. You had a couple mixed results in the regionals, but how are you thinking about net interest? How are you thinking about the banking industry right now?
Yeah, you're correct. They came out mixed. We try to stick with best of breed. We own JP Morgan and Goldman Sachs, and they both knocked it out of the park. It was interesting that Jamie Dimon wasn't on the JP Morgan call. He was traveling, but they were talking about the fact that they weren't putting a lot of share buybacks to work at these levels. And that's fine. I mean, it trades at a premium for a reason, but they did $3 billion of buybacks in the first quarter and $4.9 billion of buybacks in the second quarter. So it's not as if they think the stock is just so overvalued that they're selling it. I really like and have tremendous confidence in the ability of both of those institutions to be part of a merger, acquisition, IPO, investment banking reawakening if that day ever happens. So for those reasons, we like to stick with the best of breed diversified companies as opposed to the more traditional banks. Looked like Bank of America had really good numbers, and I thought Morgan Stanley's were fine. I didn't think they were bad at all. And I know the stock is sold off. Schwab for the past 2 days is taking it on the chin. We don't own those they're not investments that we own, but they're companies that we watch and we follow. But for now, we're sticking with best of breed, and that's served us incredibly well, both in recent times and you know over the decade plus that we've been running this particular strategy.
Buybacks are great for investors. We all know that. Why are politicians so hell bent on hating buybacks? I mean, it doesn't make any common sense, but I guess a lot of politicians don't make any common sense. So is that really what's going on, or is there really a negative benefit to buybacks?
I guess it depends on the politician. But buybacks are really good for shareholders, and it's in some ways a testament to a great company. You know, there's only a handful of things you can do with cash. You can buy back your shares, you can distribute it to shareholders through dividends, you can invest in CapEx, or you can make acquisitions. And making acquisitions just for the sake of acquisitions is not good business. Paying dividends is great when you can do it, but you don't want to make your dividend variable. So share buybacks are a great way to take advantage of a strong year and invest in your own company. I think that's all incredibly American, and I'm a tremendous supporter of it.
You had a question?
Yeah, I was going to just quickly bring up the banking sector. in general? I know there's a chart that's been popping up for the last, let's say, 18 months talking about unrealized losses, held to maturity losses. Obviously, you own the best in breed, so it's not a huge concern for your holdings. But in general, does it concern you at all at the number of unrealized losses that some of these banks that didn't manage duration well during the interest rate hiking cycle? Do you have any concern there?
Yes, of course, especially in the commercial space, which is why we're very careful not to invest in the banks that are small and undercapitalized. But they did a really neat thing in March of last year when we had the regional banking crisis. We decided that instead of marking to market, we'll mark to par, and it made everything really great. It's like when you take away the college tuition or whatever the thing is with respect to college loans, like where does it go? Oh, it's gone. We just made it go away. So there are lots of fun things you can do with
So
smoke
you're
and
not in
mirrors.
favor of that?
No, because like an economy doesn't work that way. You don't borrow money and then not pay it back. So it's great. It's great if you're maybe trying to endear yourself with a certain segment of the world, but probably not great in trying to run like a company that has a country that has a really high deficit. But that's maybe a conversation for another day. With respect to the regional banks that have been able to mark to book or mark to par, interest rates coming down will take a lot of pressure off of that. And that's where we're at now. The Fed is basically said we're going to cut rates, and we're probably going to cut rates in September and December, and we'll continue that rate cutting if everything goes okay into 2026. So it takes a lot of pressure off the regional banks. If you roll over on a growth recession cliff, then that becomes a whole fresh set of problems. If you decide that you're going to go for subprime once again and get caught up in that, because history has a tendency to repeat itself. If we go down that path, that's problematic. But I think easing rates will take a lot of pressure off of the neck of the regional banks.
Are we going to get a rate cut this year?
Yeah, we'll get 2 rate cuts. The market's priced that in since for the past quarter. And the Fed basically said that this week. Chairman Powell was at the Economic Club of New York with Rubenstein and didn't back away from any of the September guidelines. We have a meeting in July. We're not going to get a surprise rate cut in July, I don't think, but we'll be able to set the table. It's been a very communicative Fed. They've done a phenomenal job. People criticize them heavily. Every single person would come on CNBC or Fox Business or take your pick of the media and talk about how they started the rate hikes too late. They started them way too late. Everybody said that to a person, almost as if it was a signed, sealed, and delivered fact. But we're sitting here watching the soft landing actually happen, which is amazing. I was in the business in 1995, and a lot of people say we had a soft landing then, but we weren't coming off of a 0 interest rate base. So starting at this next meeting, if not before them, we're going to be saying, did they wait too long to cut rates? Are we going to push this economy into a spiral because we didn't cut rates soon enough? So I give them the benefit of the doubt at the moment, but just watch and see how quickly the news media picks up on that, and we start talking about the criticism of how they waited too long.
Yeah, Dr. Siegel says that the Fed is giving Jerome Powell the Nobel Peace Prize is like giving a prize to somebody, a drunk driver who hit somebody with their car, but was able to take them to the hospital and save their life. So he's been a little more critical. Sounds like you're not quite as critical. What score would you give him? 1 through 10, 10 being the highest?
Well, I totally disagree with the professor, because so far, despite every challenge against them, they've accomplished it. It doesn't mean it can't slip and you break the glass, but you can't not give them a 10, because it's just an incredible, whether it's their foresight or probably more so the endurance of the labor market and the ability to justify paying higher prices because of a pandemic. Whatever the reason is, they get the credit, and I would score it a 10.
What do you think about the housing market here? You're seeing such a huge difference between the top 10% of income earners and asset holders. Then you see a lot of people on the millennial side of the spectrum who really have not kept their earnings, haven't kept pace with what's going on with inflation, with housing prices. Where do you see that going? Are people just going to be renting for longer? How do you look at housing?
The 12 years of 0 or near 0 interest rates it changes the psychology of everything that goes into debt. So bringing rates down and getting mortgage rates below, if you could get it below 6% and get them to 5.99, I think that would do wonders for getting people's confidence in buying homes again. Increasing the supply can also help bring prices down. But the psychology and the barrier of mentally paying 7.5% when just 2 years ago I could have paid 3.5% is really difficult. And a lot of people aren't looking to move to upgrade that interest rate either. So it's a weird dynamic when you have a rate hike cycle to the extent that we did in the compressed time period that we did, which makes it a wonder to me how we didn't slip into a recession. I mean, with an inverted yield curve for 2 years, it's a testament to what the Fed's done with inflation coming down, which includes rent equivalence and housing, because that's what made the CPI number so good, is that housing didn't go up as much as they thought. And if there is really a true lag effect, which I believe that there is in housing and rent equivalence, we should continue to see that improve. So if we get lower rates in next year and we can see a mortgage rate at 5.99, I think you'll see a lot of people feeling much more comfortable making a commitment that in many cases is 30 years. Even though you might not stay in the home for 30 years, signing your name to a 30-year obligation is a very, very big deal, especially for first-time home buyers.
Aren't these mortgages also being priced a little bit too rich right now anyway? I mean, the spreads have blown out a little bit on mortgage. We've all seen that. Don't you think the spread should come back down a little bit too?
I think they almost have to, because you're not going to be able to move product without it. It goes back to that commentary that I made earlier about the post-pandemic, where everybody could raise prices. Coke, Pepsi could raise prices and sales would still go up. And that, again, defies logic, except for the fact that we shut down as an economy, which, hopefully never happens again.
Yeah, what's your take on the actions we took during COVID, turning off like a light switch, turning it back on? It seems disastrous. It sounds like you agree, but why do we approach it that way? I don't think we've ever done that before. In Spanish flu, we didn't do that. Why did we do it this time around?
Well, we may have done it as a society in the country once previously. I'm not sure this is the right place to get off on a weird tangent like that, but to your point, like, this was a big shutdown and we spent a lot of money. Like, we put and printed a whole heck of a lot of money in the monetary supply. If you look at that whole calculus, it's insane, but it was appropriate. I think everyone that decided to do things the way they did, they made the right decisions at the time. The stimulus needed to be distributed to keep the country moving forward and like afloat. So you can look at it in hindsight and be very critical, but I think at the time it made sense to do so. So I'm not one for big stimulus and handouts, but that was a very appropriate time to have done it. And I think it will take us a number of years to digest all that money that we printed. But again, you look at the labor force, and that's what really fuels our economy more than anything else. And as long as people want a job and they can get a job, that's the most important thing. And doing that after you shut down an economy is like unfathomable that it's worked. What's the ripple effect? Well, the ripple effect is a lot of people don't like to go to work 5 days a week in the office, but hopefully that trend gets closer to normal. And I think it has every quarter. So if that's the worst thing that we have to deal with, I think that we can be very proud of how we responded as a country.
Yeah, and it seems like population growth trends really go right in hand in glove with economic growth. We've seen economic growth here in the U.S. because we had very slow but steady population growth. Europe has not had that. You have not had that, obviously, in China, Japan. What do you think about international markets? Is it just structural in some of those places? Like, structurally, it's going to be really tough for China to really boom long term. You got guys like Peter Zeihan who say China's got 10 years left before they collapse. What are your thoughts on international markets?
Well, I'm sure Ray Dalio would give an opposite opinion on that one, but there's opportunities overseas for sure. We run an ETF DVO that is an international strategy, but within that portfolio, we really try to stick with best of breed companies. So in any society, you're going to have things that do really well and things that do poorly. We're not necessarily making country allocations based on what their entire economy is forecasted over the next 10 years. But China's an interesting story because for so long they could make up any numbers they wanted, and who's going to challenge them? But that can last for only so long. So eventually it comes down to dollars and cents and profitability. So you can blur the numbers for only so long. But I have a lot of confidence in the international portfolio that we've built, and there's certainly some risk when you invest outside of the US. So I'm not suggesting that someone should or should not invest in IDEVO. You know, I don't always drink beer, but when I do, it's kind of the same thing. If you want to be invested internationally, having a covered call portfolio and a heavy emphasis on dividends gives you a little bit of that drawdown protection, and smooths out the volatility a little bit.
Do you hold a similar number of names in that international strategy compared to Devo?
No, it's like double, because you do have more
Okay.
inherent risk when you're dealing with international names. We trade everything with ADRs and US based options, but you want to have a more diversified net, I think, internationally, and it's served us really well.
Kevin, quick question for you on the we like to do a little crystal ball segment here. So this is our crystal ball. If you can look into the crystal ball, tell everyone, where do you see markets trading next 12 to 18 months?
Well, that's for your in-person guests who can see it. Unfortunately, I'm on Zoom, so I'll hedge my bet. But I feel like there's a strong probability that stocks could be trading higher in 12 to 18 months than they are today, even though I think they're priced to perfection. And the reason for that is if earnings come through for 2025 and they're at 270 to 275, you're going to see a stock market that's higher. If interest rates continue to come down, which we expect that they will, that's positive for equities. And finally, if we see a continuation of that into 2026, now in 1 year from today, in July of 2025, we'll be looking at the earnings for 2026 and pricing that in. And if you're still looking at 10, 11% growth into 2026, it's a good runway for equities. How long that things last, they don't last forever. There's always air pockets and volatility. In the old days, we would get 10% drawdowns pretty much every year, like clockwork. We would get a 20% drawdown every other year. Nobody like freaked out about it, but we haven't seen that type of air pocket lately. And what we need to be aware of is that they happen. They're not a reason to sell and to panic for most cases. Even if you look at 2008 or if you look at 2020, there were pretty good buying opportunities, but messes with your head. The emotions are what messes up people and leads to poor performance. But I would think that if the crystal ball is working through the Zoom, that we would be higher in 12 to 18 months, if only modestly.
So these FactSet projections and some of these other places like Yardeni Research and a couple other outfits that are saying, hey, it looks like we're going to get $310 to $315 in 2026. Obviously super long range in this business, but do you multiply that by 20? Is that the right multiple? And say the S&P is worth, between 6,300 points by the end of next year. Is that the right math there? Or how do you think about that?
Depends on whether or not we go into a recession, because you're pricing at 20 to 21 times earnings higher than historically we've done so. But that also lends itself to more tech being part of the broader indices and these magnificent 7 stocks lifting up the multiples on the index. But I think it's a fair way to look at it for sure. That would be another thing you can ask Professor Siegel when he's on here, because he'll start screaming about the multiple and the valuation. But if you see stagnant growth and a recession, you can't price it at 20. You have to price it closer to 17. And instead of taking you up to 63, 6,500, that probably knocks 1,000 points off of the S&P 500. So makes what we do super fun.
Absolutely. Well, one question in closing, let's make it a little controversial here before we end. November's coming up pretty soon. What do you think's going to happen?
Sadly, it's not coming up soon enough. If we had an election today, I think it's very obvious how it would end up. But we have, as we're recording this now, over 100 days until the election, so a lot can change. I think if you're a Republican, you'll be happy that there's a lot more Republicans getting elected in November. What happens in the White House is a lot less impactful than what we might think. Emotionally, the tension is always very, very high. We had a horrific assassination attempt on President Trump. I mean, this is like a sickening thing that we've been discussing it. But I feel like we know what each of these candidates brings to the table because we've seen each one of them in office for 4 years. So whoever gets elected is immediately, talking about a 4-year term, not an 8-year term. So it has the ability to bring a lot of people together. It has the ability to bring a lot of young and bright people to the forefront. So however the outcome, I hope for a better United States after the election in November.
Yeah, it seems like the makeup of Congress matters a lot more if you can get, Republicans to take back the Senate, hold the House. It seems like that matters a lot more to markets than having President Trump in office or somebody else.
Well, it does because you have the Trump tax cuts expiring. So if you're, again, a little bit more pro-business and pro-stimulus, you probably want to see more Republicans. Neither party right now is looking to bring down the deficit. So we're going to be spending in one area or another. I'm just a strong believer that with lower corporate taxes, it's better for the consumer, and more stimulus, I think generally is not. But
well, Trump just came out and said 15%, I think, was what he would cut corporate tax rates to. So
yeah, I tend to think they should be zero, but I'm it's incredible capitalist from the standpoint that I believe that the companies could do a whole lot of hiring as opposed to paying a whole lot of taxes. But yeah, 15% would be fantastic.
What about these knuckleheads who say that the Trump tax cuts led to higher inflation? I mean, how insane is that idea?
Well, that's why you have a two-party system, because there's an argument to be made that we would have had lower inflation if we paid more in taxes because the government is so efficient in how they spend money. Unfortunately, that argument doesn't hold a whole lot of water in the real world. So I feel like there's so many people that don't pay taxes and receive entitlements that, what we need to look at isn't paying more taxes or paying less taxes or having more entitlements or less entitlements. What we really need to do is to come together and look at spending. How do we spend less? And the reality of someone trying to get elected to do that is just so challenging that's the one sort of flaw in the system, is that you don't want to campaign on spending less and raising taxes. It's not something that voters are really excited about. So instead, you campaign on entitlements and tax cuts so that you can get elected. So maybe if we see Republicans who are there for a 4-year program, they can focus on just trying to balance the budget a little bit. It's not unheard of. It's how a business is run, and I think that would serve the country really well also.
Kevin, last question for you. The show is called Bullish. Are you bullish?
I'm cautiously bullish.
We'll throw an asterisk on there.
Yeah.
Yeah.
The cautious bull.
Yeah, exactly. Well, Kevin, we really appreciate your insights today, and sharing your expertise with us and also our clients who listen to this. So, folks, remember, if you like the show, be sure to subscribe, share it. It's on YouTube, Spotify, Apple Podcasts. Give Nick's show, the Nick Stenger Show, a listen as well. He puts out a show weekly. So we hope you all have a wonderful rest of the week. And Kevin, thank you again for joining us.
Thanks, guys. It was a lot of fun.